Happy Tuesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Tuesday, June 18th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio, you need to be a client of 42 Macro. So today's key macro events are retail sales and industrial production point to stasis in the U.S. economy and buoyant U.S. capital markets. In terms of market implications, the latest batch of economic data point to stasis in the U.S. economy. Is U.S. growth on the precipice of a persistent downside surprises? Unlikely. Consensus expectations call for growth to slow to a below trend pace in Q3. As detailed in our June 2024 macro scouting report, leading indicators of the business cycle do not point to a sharp, sudden slowdown in the months ahead. We believe growth is likely to slow over the medium term, just not at a pace that causes significant problems for risk assets. Elsewhere, the latest data indicate U.S. capital markets remain buoyant. That has positive implications for nominal growth in the hyper-financialized U.S. economy. Transitioning to our 42 macro dashboard here, as always, we'll wrap up with a question from our community. This one is titled Moving Away from 60/40. It reads, Hi Darius, enjoyed your talk with Chris from Ampus Group. A lot of the vol talk went over my head, but it was interesting how you approach your research from different perspectives. Towards the end, you both talked about the potential for higher inflation ahead and 40% in bonds not being the right allocation going forward. I'm hearing a lot more talking heads talk about a decade of higher inflation. However, for the asset allocators that matter, pension funds, fund managers, etc., curious how long it would be before they come to this realization to set in, if at all. I know you can't give precise timing, but would it be but you can't give precise timing, but would it be a generation, or are you already starting to see this happen? So it's an excellent question, phenomenal question, and thank you for the kind compliments. So in our view, it just depends on the price, the speed with which they divest themselves out of this asset class depends on sort of the speed with which interest rates are rising. If interest rates are meeting their ex ante return obligations, either from an asset liability matching standpoint, i.e., you're trying to match your assets in your portfolio with the growth rate of your liabilities, if you're an insurance fund or a pension fund. If the ex ante returns that these funds are demanding meets those types of those obligations, then they will happily continue to invest in treasury bonds. The problem is, as you go forward in time, the likelihood that the Fed and commercial banks will be either money printing and or financially repressed into the treasury market in a way that makes those ex ante returns, i.e. yields, too low, then you could potentially be looking at a scenario where pension funds and insurance funds and other investors in long-term sovereign debt will have to look elsewhere to meet the liability, to match their liabilities, to match their assets rather with their liabilities. And so it just depends on the level of yields at various times. Obviously, folks like us who are a little bit more forward-looking and a lot more nimble from the perspective of their asset allocation and portfolio construction, we can see the writing on the wall with respect to the likelihood that we do have persistent elevated inflation in this regime for a variety of factors. Many of them are symptoms of the forthturning economic and political regime that we're in, much like the ending of the Saudi U.S. petrodollar contract and the potential for that, the potential that has to create a significant outflow of investment from the treasury market through the lens of Saudi Arabia and other related current economies of foreign exchange reserves. Now, again, none of this stuff is going to happen overnight. We're talking about the U.S. is an economy that has that the rest of the world. The U.S. owes the rest of the world $19.8 trillion in terms of the size of our net international investment position. So a lot of these dynamics that we're talking about that are all sort of tied together in the context of down dollar, more inflation, less demand for treasuries. It's all kind of one big thing. We're just talking about different aspects of this one big thing. None of this stuff, in our opinion, is likely to happen overnight because, again, expeditious divestment from the treasury market will be akin to lighting their own assets on fire. And of course, obviously, you don't want to poke the bear that is the U.S. military. And so, this is a process that is going to be ongoing for quite a while, but it's not going to be something, in our opinion, that market's going to have to risk manage in a sharp shut-in in a material way. So this is just, kind of set and forget it for now. So we'll wrap it up there. Darius Dale presenting our macro minute for Tuesday, June 18th, 2024. Everyone have a wonderful day. Best of luck out there. We'll catch you back tomorrow. Cheers.